This video clip just looks at the recognition of an investment in an associate and the typical adjustments that are made to that value subsequent to the investment being made. Now, the first entry will be your recognizing your investment at cost, and that would be in the records of the investor. Now, that cost amount is what you've paid for the investment, but it consists of two components. In a separate video clip, we'll look at the acquisition analysis that is done when making an investment in an associate. But that cost consists of two elements. First of all, the investor's share, so that would maybe be a 25% or a 40%, depending on the size of the investment. So the investor's share of the fair value of the associate's identifiable assets and liabilities. Now, we might see that the identifiable assets and liabilities in the associate is valued at their carrying amount, which might not agree to the fair value of those items. Might be the case for all of the assets and liabilities or for only some of the assets or the liabilities. But irrespective of the case, if there's a difference between the fair value of the assets and the liabilities of the associate and their respective fair values, we need to make a notional adjustment for that difference in our acquisition analysis. What that means is that we make an adjustment to revalue those items to their fair value, but we don't pass that in the records of the associate. We only make the adjustments in our acquisition analysis calculation, but we'll cover that in the other video clip. So that's the one component of the cost. The second component is then whether we've paid a premium for our share in those identifiable assets and liabilities, in which case we also purchase some goodwill, or whether we paid less for those items than what their fair values are, in which case there is an excess income which needs to be taken into account in our calculations. But more on that in the other video clip. Our aim is to show our investment in associate at our share of the associate's equity figure. Now, there will be differences between the investment that is lying, the value of the investment that is lying in the investor's accounts, and the actual share of the equity, and that's as a result of unrealized profit that is adjusted for, and so forth, and I'll make a brief comment on that. But if we ignore that for the moment, the adjustments that are on the screen are the typical adjustments that you'll see, and the answer in the end should lead you to a figure that is equal to the investor's share of the associate's equity included in his financial records. So we've recorded the investment at cost, and then subsequent to that, so maybe this was at the beginning of the year, so at the end of the financial year, and for subsequent periods, we have to adjust for our share as the investor, our share of the associate's profit or loss for the year after tax, but before other comprehensive income and distributions to shareholders. So we calculate our share then of the profit or loss that was reported by the associate for the year after the tax provisions has been made. Our share of the profit and loss is then basically our share of the post-acquisition earnings of the associate, and basically the result of the accounting statement is then to only include the realized profit or losses that is reported by the associate. So only the profit and losses resulting from transactions with parties apart from transactions between the associate and the investor. So only other parties' transactions results are included in that figure. That's why you'll see that later on in the textbooks adjustments are made for unrealized profit on transactions between the investor and the associate. Now those adjustments for the unrealized profit, as well as if there's any differences in accounting policies that requires an adjustment to be made, or if we had a difference in fair value between the fair value and the carrying amount of assets on acquisition date, though it's not actually just the date that the investment is made, that difference in the carrying amount and the fair value includes a portion of an expectation of future earnings. So as well as a component of pre-acquisition earnings, and therefore we also need to adjust for that pre-acquisition earnings. But these adjustments I'm not going to cover in this discussion. I just want to make the comment that if we make any adjustments like these, the unrealized profit or accounting policy or pre-acquisition earnings that needs to be adjusted, because this adjustment is made to the profit and loss figure after tax, these adjustments should also always be made after tax. So you'll see if you look at examples where the unrealized profit is adjusted, it's the after tax figure that we use. The next typical adjustment that has to be made to the value of the investment in associate in the investor's accounts is an adjustment relating to distributions to shareholders, and that would, for example, be dividends. The net effect of this adjustment is that no dividend revenue is recognized in the investor's accounts resulting from his investment in the associate. The reason for that is that when we adjusted for our share in profit and loss before distributions to shareholders, the investor in effect already accounted for his share that he received in dividends, so his share in the associate's equity. So if we record our dividend income as well, we'll be in effect double accounting for that. So when the investor is not a parent company, so therefore he's not consolidating, he would have passed an entry when he received the dividends, as debit our bank, credit our dividend revenue. So when we apply our equity method, we'll say we're going to debit our dividend revenue and reduce our investment in associate line item. My apologies that I got the two mixed up there, so let's just look at that journal again. So, okay, so where's my pen? When the dividends are paid to the investor and they're not consolidating, so they're not a parent company, instead of pausing that first journal, debit bank, credit your dividend revenue, he's just going to pause debit bank and credit our investment in associate line item. Because remember, all our entries that affect our investment in associate is done against this line item in our accounting records. So what we're doing with this journal then is to reduce our investment with our dividend amount, because our dividend already flowed through when we included our share of the profits before the distributions were made. If, however, we were consolidating, so it is a parent company and there's a group structure, so he has to prepare consolidated financial statements. He's still going to equity account for his investment in the associate, but it's not going to happen in his accounting records. It's going to happen on the consolidation worksheet. So we'll see that in this case the parent will pause an entry, debit bank, credit dividend revenue, but a consolidation entry will be paused to eliminate that dividend revenue by debiting our dividend revenue and crediting our investment in associate. So as you can see, the net effect of the entry on consolidation is to eliminate our dividend revenue that we've recorded in the parent company's accounting records, and we sit with the same journal again. Okay, so any distributions to shareholders are adjusted for because we've already included our share of the earnings before the distributions were made.